but there's probably some nuances, and I think I've got some takeaways for you. So let's get started. Let me click this. I think this is okay. So I want to briefly say what I want to try to cover tonight, and I think I can get through it all, but I want to explain to you about implied volatility versus historical volatility. And I think standard deviation seems like a scary word because most of us probably fell asleep in a statistics class in college and didn't spend a lot of time, but it really isn't. I'll give you a few real-world analogies, which I like to do. Those of you that I've coached and that, I like to have real-world analogies. I think it kind of brings it together. I want to talk about how implied volatility and standard deviation are linked, because I throw those terms around a lot when they're in the room, either with the options or with the futures, and you probably can't connect all the dots. So we'll talk about that. I thought I would throw in there, why should I care? I hope I can show you why you should care. And how can I use the quantifiable results to improve your edge in trading? And I want to tie together, there's a lot of acronyms we throw around. This is particularly related to the Thinkorswim platform, the probability in the money, out of the money, delta, and all that stuff. And I want to kind of tie that together for you a little bit. And then this will really be a foundation for understanding the use of options to hedge stocks, options, and futures. And as I say, almost every day, I'm product indifferent. If I'm trading futures or if I'm trading stocks or options or whatever, I'm product indifferent. And everything I do with the probability-based stuff is centered around that. And my focus in most of the time, I like to sell premium and not buy premium. And so my focus most of the time is to lower or raise the cost basis, depending on what I'm short or long. Let's start. So I want to talk to you a little bit of implied volatility. A little, I don't want to read you the Webster's dictionary definition, but I want you to think about implied volatility because I do throw that term around a lot, and it's really just the estimated volatility of the underlying security. And you really need to keep in mind that the word implied is key, because implied is talking about something that's going to occur in the future. We think the volatility is going to be this, so we're going to price the options at this number, as opposed to historical, obviously, which we already know what the number is. So the key word is really implied, and I want you to kind of contrast that with implied versus historical. If we say the implied volatility on the SPY today is 20%, we're hedging our bet a little bit, or the market makers, the formulas that generate the volatility. But if we look back a month, we know what we know it was 19.2% or 17.1 or whatever. So historical volatility is just what it was in the past. It's a fact now. We know what that volatility is, and we could obviously document that. Implied volatility is what we think it's going to be. We have a pretty good understanding, and as the definition said, suggested but not directly expressed. So I think that should clear it up a little bit. And if you have any questions, like I said, we'll cover those at the end. So what is implied volatility? Now, in general, implied volatility increases when the market's bearish. I think you guys all know that. And investors believe that the asset's price will decline over time. And it decreases. We see that all the time. There are a few counter underlines, but for the most part, when the market goes up, volatility goes down and vice versa. And this is really due to the belief that bearish markets are much riskier than bullish markets. And I'm going to kind of tie that together for you as a premium seller versus a premium buyer. And implied volatility is just a way for us to estimate the future fluctuations. Remember the term implied. It's not definite. It's implied volatility. And of course, in the option space, puts are typically more expensive than calls. We do have times when if you're equidistant away from the strike, that the calls may be higher in value than the puts, but most of the time puts are more expensive and than calls are. In finance, standard deviation is just applied to the return of an investment to measure its volatility. And that's just a bunch of gobbledygook to tell you that the standard deviation is how we calculate and forecast what the impact of the volatility is going to have on an underlying. In probability, I've got to get probability in there. It's directly related to implied volatility through standard deviation. And I'm a probability-based trader. I'm a strong believer in the probabilities. It has turned my trading around. And I only hope that I can help those that, my story with Bear Stearns and losing all that Roth IRA. And I'm hoping that I can shorten your learning curve, because all this stuff is it's public domain. I'm a little slow learner. Probably took me 15 years to finally get to the point to say, hey, introduce to this stuff and then figure out that it makes sense. But I want to show you that I believe in my heart of hearts that probability is really the way to trade. But nonetheless, it is directly related to implied volatility through standard deviation. Now, as we become aware, and perhaps I'm being a little presumptuous, but as I become aware, more committed to probability-based trading, we find that we can control the probability of profit on any trade we consider. And we talk about that all the time. I talk about that individually with coaching clients, and I mentioned the room. We're always looking to collect a third of the width of the strike on a defined risk credit spread. We know that we got about a 70% probability of success and a 30% probability of losing, but we can control that. And I can sit here. It's comforting knowing that I can sit here next year and I know that my win rate's going to be around 75%. I don't know how much money I'm going to make because that depends on the volatility, which has, of course, been low lately. That gives me enough premium, but we can control the probability of profit on really any trade that we consider. Now, here's the kicker, and here's why I'm glad you're here tonight. And most traders have absolutely no clue that this information that I'm sharing with you exists, or much less how to use it. In fact, I would go a step further and say most of your money managers or your certified professional planners or whatever they are have no clue. And I typically will challenge clients, and I'll say, the next time you sit down, and this is a time of the year where you sit down and reassess, you sit down with your money manager, look them in the eye and say, just real simple, said, what are you doing to lower the cost basis of my portfolio? Because most of you are long. So, and if he looks at you with, or he or she looks at you with kind of crossed eyes, it might be time to rethink the whole process. And I would, like I said, I bet you 99% of the money managers have no clue what you mean to lower or raise the cost basis. But in most money managed funds, we're typically long. So you really just have to say, what are you doing to lower the cost basis of my portfolio, or improve the cost basis of my portfolio? Because if we can lower and improve the cost basis, that increases my probability of profit. Be interesting to see their response. So other things to consider with implied volatility is that that's for sure. Risk is commensurate with reward. And this is really important. And I think we've got, I know I'm when I say I think I'm talking about me, because I traded futures pretty unsuccessfully for probably 8 or 10 years, and stocks and options and all that stuff. And I was always led to believe that, risk two to make, risk one to make two and all that kind of stuff. And I hope I can show you through volatility and standard deviation why that is really kind of a losing battle. But obviously, the more risk you take, the greater reward. And I mean, we do that. When I was young, I mean, you go to the bank, you get 12 or 13% on a CD or more in the 80s. But now you get, a quarter of 1%, and they think you don't even get a toaster anymore. So you could go very, very safe, take very little risk, and your reward's low. And that's, I think you all understand that. But I did want to put that in here. And another thing you really, really got to remember, and I'll give you an analogy kind of out of order, but that fear or volatility is overpriced. And if you think about that, almost everything you do, fear is overpriced. I mean, the insurance companies are overpricing fear. They're overpricing the risk on your car insurance, on your house insurance, and down here on hurricane insurance, or what the case may be. So just really always keep that maybe not in the back of your mind, but in the front of your mind, that fear is overpriced. And I'll digress for a minute. Just in my case, I'm in the Medicare generation now, and that has to be your primary coverage. And of course, you've got to go out every year and buy some type of a supplement. And I've been paying, a couple of $100 a month for something, some plan F or Q or whatever it was, and we really looked into it, and we decided to get this Medicare Advantage. It's $41 a month. Now, if you think about it for a minute and start relating this to your real life, and you say fear's overpriced, then I'm better off paying the $41 a month and then paying a higher deductible. It's kind of pay me now or pay me later. So that's just a little kind of something for you to think about that. Gosh, when I go buy insurance, the higher we raise our deductibles, obviously the more it goes down. And so, but the insurance company and the casinos are always going to have the edge. So it's real important to keep in your mind that fear or volatility is overpriced. So for that reason, and for that reason alone, almost alone, premium sellers, which is primarily what I am and what I hope you will be, will typically demand more premium for the additional risk. So we're overpricing those options we're selling. We're not actually putting the price on them, but we're selling them. We assess whether we think it's a good deal, or are we collecting a fair reward for the risk we're doing. And the options are, again, fear being overpriced. The options are overpriced. So we're much better off selling those options than we are buying them. So the higher prices that are demanded by the sellers cause these probabilities to exaggerate the predicted movement. And that's what I talk about all the time. Volatility is overstated, fear is overpriced. We're going to sell the one standard deviation because we know that 70% of the time it's going to be contained, and we'll cover that in a little bit. But all those are really, really important. And by the way, I've made a PDF of these files for you, so I'll release them when we get done here if I can. I think I've got to understand that. So, and here's a little funny one I got from, I think it was one of John Carter's webinars or somewhere. It says, premium buyers have better stories to tell, but premium sellers drive more expensive cars, or something like that. I'm kind of, I don't know if that's exactly verbatim, but if you think about it, everybody likes to go to the party and say, I bought Apple at 100 and now it's 120, and talk about those all those stories, and they do have the much better stories, but the premium sellers do drive the more expensive cars. Okay, we're doing pretty good. Now I told you fear is overpriced, and keep that in your mind, and always remember, in any walk of life, anything that you're doing, hopefully you'll rethink things a little bit and think, do I really want to buy that extra insurance on this tablet that I just bought? I just bought a new little Samsung tablet, this 9.7 inch one, and it's like $80 for insurance for the first year and $140 for 2 years. I said, time out. Now that I'm a premium seller, I'm not doing that anymore. So anyway, that's how it will kind of relate to what you do in every walk of life. But some other important keys are, remember, implied volatility is overstated because fear is overstated. And remember, and I say it in the room all the time, implied volatility is mean reverting. Price is not necessarily mean reverting. I think we all know that. We might think it is, but implied volatility is mean reverting. And we're going to find out, because implied volatility has been pretty low, and our opportunities will come. And you'll see that some days we'll go, but I always talk about Groundhog Day. This year it seems like every day the volatility is low, but then you'll get one or 2 days where it spikes up, and it just it turns your P&L around. I'm not going to spend a lot of time. I don't need to read to you. I think you know what historical volatility is. Historical is just what the actual realized volatility is. Again, think of it in contrast to implied volatility. We know options, again, they're always overvalued, and because they're hedging. The person, we're selling that premium. We're taking that risk. We want a little bit of an edge. So historical volatility is just merely what's occurred in the past, and something that we can obviously document, and we have a firm hard number of what it was, and really standard deviation was what I'm going to talk about is really the most common, but it's not the only way to calculate historical volatility. And don't let all that really confuse you. And we don't really have to dwell on historical volatility, but just remember always that that implied volatility is overstated, and typically what's anticipated or implied is going to be higher than what reality or what the historical volatility turns out to be. All right, so now the scary word. What is standard deviation? And it's really not that scary. And like I said, I don't know if you remember any of it from college statistics. I certainly don't, but I wish I'd have paid more attention. But it's really just a statistical measurement that sheds light on historical volatility. And I put a couple examples down. A volatile stock will have a high standard deviation, and a blue chip stock will have a much more stable standard deviation, much tighter. And so the large dispersion will tell us that the return is deviating from the expected normal return. So if we've got a normal return and we start to get a large dispersion, then we're deviating, we're getting outside those norms. And standard deviation just measures that dispersion. And don't get all bogged down with trying to remember these definitions and all. It's really not important, because I want to show you and I want to share with you the what really makes a lot of sense and what's really right on the platform. You don't have to be a math savant to know this. So, and we all know that how I calculate standard deviation and the square root. We'll talk a little bit about that formula. So what does standard deviation predict? And this is where I really want to make sure you understand, and if you have any questions, make sure we cover those today, because again, I talk about that. I go into probability out of the money and implied volatility and standard deviation. But for our purposes, the implied volatility of an option is equal to one standard deviation. So, and I'll show some of the things I show in the room, some of the spreadsheets I show in the room. But the implied volatility is equal to one standard deviation of the annualized expected move. So here's an example that I think we could all get our head around and make the math easy. So if we take a $100 stock and the implied volatility the implied volatility is 20%. So we know that a one standard deviation of this stock, the price is in the middle at 100. 20% of 100 is, of course, $20. So the expected range of the stock over 1 year is 80 to 120. And we know that that expected range price of that stock is going to stay between 80 and 120, 68.2% of the time, one standard deviation. And that's how implied volatility and standard deviation are really joined at the hip, because the implied volatility tells us what one standard deviation is. Now, as you know, my kind of sweet spot for trades is 45 days. So how can we use implied volatility that is telling us what's going to happen for a year? Well, there's a very simple kind of back of the napkin calculation, which I won't bore you with the details right now, but we can figure out pretty easily what the expected move is for whatever period of time, and we'll go over that on a couple of the spreadsheets. So it should be easy for you to, hopefully it's easy for you to understand that if we have the right technology, which we have on our platforms, we can use this in our trading to predict the potential range. So when somebody says, I think Apple's going to be 200 by the end of the year, just go to the probability of the standard deviation and find out, yeah, it's going to be 200. There's about a 2% chance of that, or whatever the case may be. But that's why you have to brush some of that stuff off. It's easy. There's been so many of these people that throw those predictions out, and they never really have to defend them, because if they're right, they pound the table forever. I remember if you remember, was Joseph Glanville way back, and Abby Joseph Cohen and all that, and they're pounding the table about this, and yeah, they're right, and they tell you when they're right. So but they don't tell you when they're wrong. Steve, the DTA is days to expiration. So let me go into that formula. So if we want to figure a one standard deviation move, which will contain our price 68.2% of the time, we just simply have to take the price, like in this case it's 100, times the IV, which is 20, times the square root of days to expiration. In this case, it would be 365 over 365. It would be 1. So price 100 times IV times 1 would obviously be 20. The expected move would be $20, and that's plus or minus 20. So we have a $40 range. So, but again, most of the time, what we deal with is much all the time. It's a much smaller time frame than 1 year. So we'll be plugged in that formula, and we would take the price of 100 times the IV of 20 times the square root of, in this case, say 45 over 365, and that will give you the one standard deviation expected move. But you don't have to do that. It's on the platform, and it's on some of the spreadsheets I have. So like I said, with the technology that we have in front of us and available to us, and with Excel spreadsheets, we can always figure that out, but it's really not even necessary because virtually any underlying that you're looking at, security instrument, we can look right on the platform and see the standard deviation. So I'm just going to real brief. I talked on a couple real world analogies, and I said in the list of things we're going to cover, and just a few things to think about that. About standard deviation and probabilities, that math, meaning statistics, are really everywhere. You've got obviously insurance actuarial tables, you got population demographics, you got grade exams, and in the old days when we were in college on the curve, birth, deaths, and of course for a golfer we got probabilities of a hole in one. And I don't know what that is, but you can find out what the probability is for a hole in one. So basically there are real world analogies everywhere, and we're not gonna really need to go into them. If something pops in my mind I might help you out, but I just wanted you to know that we deal with probabilities every day, and I know in trading we want to put trades on, and we're more afraid of losing and getting stopped out or whatever the case may be, but we don't think anything about jumping in a car and going out, and we may be in a accident, and maybe even a very serious one. The probabilities are very, very high. I don't know probably a 5 or 6 standard deviation, or 1 in 500,000 probability, but nonetheless that does exist. So, all right. So here's where I want to really spend some time. I know you've seen this normal distribution curve. You see me use it most every day in the room, but this is where I want you to really get your head around. We've talked about implied volatility. The implied volatility is really the standard deviation, is really the expected move of the standard deviation, one standard deviation for 1 year. But we can actually go through a formula process and decide, hey, okay, we're going to be in this trade 45 days. What range should this be contained in? So if you look on this bell curve here, you should be able to clearly see. And you really need to understand this, that if you look at it, think that the current price is right there in the middle where I have current price, and obviously the bell curve at the top, and you can see 68.2% of the time, which is 34.1 on the low side of price, 34.1 on the high side of price, 68.2% of the time, once price will be contained within one standard deviation. So that's a quantifiable edge. Now, we sell premium when the implied volatility rank is higher. We get that 68 to 70 up in the mid 70s. But for standard deviation purposes, just remember that 7 out of 10 times that the price is going to stay within that one standard deviation range. And then to expand a little bit further, almost 95 out of 100 times, it's going to stay between 2 standard deviations. So, in 3, you can go on, and I'll show you a chart a little bit later on 6 and 7 and 8 standard deviations, which are immaterial to us. But I mean, you got 99.7% of the time that price is going to be contained within 3 standard deviations. You don't get much premium out there. That's why we're typically dealing in that 1 standard deviation area, and sometimes 2, but mostly 1. But I want you to really understand that if you take a trade and you execute a trade at the current price, and you can figure out what the expected move is, or look on the chart and look at the different strikes and see about what 1 standard deviation is, or 2, whatever you're comfortable with, that you know that the price is going to be contained in there. And this is what, if you think about it kind of in this fashion, most people don't want to sell calls against their stock. And I talk about this, and especially with clients that have large portfolios, that I've tried to help them learn how to sell premium against those portfolios. But I say you don't want to sell a call against your long stock, because the typical answer, well, I don't want to cap the upside. I said, well, let me get this straight. So you're willing to sell this stock or buy the stock for $100, knowing full well that it's 50-50 whether it's going to go up or down. You may think you've read the tea leaves, you've done all this, you know the president of the company or whatever, but the reality is that that's a 50-50 shot that stock is going to move up or down. So you really don't know. But you're not willing to sell a call against that stock that is going to give you, that you've got a 70% chance of them not taking your stock and keeping that premium, and then lowering that cost basis. Maybe if you started out at 100, it's 98, and then you do it the next month, it's 96, etc. So okay, I'll go through that, Sam. I'll catch up with that at the end on the questions. I'll review back there, but that's just something it's just a little aside. But if you're comfortable with selling premium, you understand why selling premium puts the odds in your favor. Just think about that when someone makes a comment that I don't want to sell a call because I'm going to cap the upside. So you're willing to take a 50-50 shot, just like we are every day in futures. We're buying or selling futures, and we're willing to take a 50-50 shot because we don't know which way it's going. But you don't want to sell a call or a put against that future because you might, cap your upside. So just think about that. And I think that's when you start to really think about it, it's just almost mind-boggling, but that's how most people think. I mean, I've got a number of stocks right now I've sold calls against. It's blown through the upper strike, and I could have got $3 or $4 more on the stock, but I don't. They're going to call the stock away. I'll sell a put, and I'll just keep the dream alive. Okay, now what I've done here. And I put together a little expected move calculator that I'm happy to share. I'll try to put it into the room if you have an interest in it. I'm not trying to really stuff anything down your throat, of course, but you see the little yellow box up there where it says AAPL and how many days to expiry. Well, you can, with this calculator, and you see me use a more advanced one in the room, but I just did this calculator. I just thought, well, I'll put this together for this presentation, and then maybe because it's a little simpler, and we'll talk about it, and we'll look at the different cells, and maybe maybe a light bulb will go off. So with this particular calculator, all you have to do is put in the underlying. You have to have Thinkorswim because that's where you get the live data, just like the other ones. If you don't have Thinkorswim, this really won't do you much good. But because it gets live, you open up your Thinkorswim platform and it connects, and you can key in. So all you have to key in is the symbol you want to look at and the days to expiry. And you can even do it with futures in most cases, and I can help you with that a little bit, but you have to put a /. But in this case, I did Apple. I think I did this yesterday or something. It was trading. You can see I put 30 days to expiry for this example to take a picture of, and the current price was 109.90. So, and the implied volatility was 20%. So we know that Apple traded 109. 20%, we're looking at about a $22 move over the next, plus or minus over the next year. So we're looking at a $44 range. So we talked about that earlier. We understand that. But now more you can see that the one standard deviation move down below in the grayed area where it says $6.50, that takes the days to expiry into account. So is that days to expiry changes from 45 to 30 or 2 or whatever the standard deviation changes. Again, it's just simply using that back of the napkin calculation that I showed you a slide or two before. It's not, it doesn't go into the Black-Scholes model, but this is close enough for government work. So this will calculate what a one standard deviation move. So if you're interested in Apple and you're going to sell premium or you're going to buy the stock or whatever and you're going to sell a call, you can say, okay, I want to hold this for 30 days. I know that the expected move is $6.50, so that's a $13 range, 2 times the standard deviation. I can look over to my chart and I can say, okay, if you look over at the bell curve that I put on the right, one standard deviation for Apple to the downside, these are all rounded off, is 103, and to the upside is 116. Which is consistent. You got $6.50, so almost $7. So it's going to range from 103 to 116. 2 standard deviations is going to range to 97 to 123. That again, this isn't absolute, but this is putting the odds in your favor, and this is telling you what those calculations mean. And I put the little like you see 15.9% and 2.3% at the top. Those are just the probabilities that it will close below that, and I'll show that on another chart. But I just stuck those up there to kind of show. And if you go down below the 650 and the 1299 and the 1949, let me explain that to you. Where I pick up the current price at $110, and I show you the top, what 1 standard deviation, 2 standard deviations, and 3 is, and then on the bottom, -1, -2, and -3. And then to the right of that, I'm showing you, just like we saw in you see on the chart, that $116 or the $103, there's a 34.1% chance that it's going to stay within that. It's obviously it's a 15.9%. It's going to be above that, and on the downside. So we know that there's a 34% chance that it's going to stay 116 or less, and or close 34. And then on the bottom, we know there's a 34.1% chance that it's going to stay at 103 or more. In the next column over, I just kind of indented it, and it says 13.6%. So now we know that 34.1 plus 13.6, 47.7% chance that price on Apple over the next 30 days, on 30 days at expiration, is going to be less than 123 and greater than 97, and so on. So I hope that helps a little bit, and you kind of see how I kind of indented it. It's kind of if you drew a line and connecting all those, it would be kind of a cone, and that's what they call the volatility cone. But I hope that explains it, and we can get on the mic at the end if we have to go back. But I don't want to waste all your time. I want to try to wrap things up in the next 15 minutes, so we have plenty of time for Q&A. But I will make this available if you guys want to play with. I said I've got a more advanced one I'm going to have on the website. But if this stuff is all new to you and you just like to experiment around, I thought it was kind of a little fun tool. And as you change the symbol and the days to expiry, and you've got toss loaded up, it's going to pick up the price, and you'll look right over here in the bell curve area where I'm kind of circling. You'll be able to see those prices change. So I kind of fanned them out at the bottom just to kind of make them stand out a little bit more. So that's something I want to. I did not put in the. I'll dig it out. I didn't put it in the resources yet, but I will. So as we're wrapping up, really, you're probably saying, why should I even care? Because you do fundamentals, you do technicals or whatever. And like I said earlier, most traders have no clue about this stuff, or more, even to a greater extent, how in the heck to even use it. So just with this little bit of training tonight and getting your head around it, you probably know more than 99% of the traders out there. So give yourself a pat on the back for that. And so The knowledge of all this stuff will give you an edge even over the self-proclaimed experts, the guys that took my 250,000 Roth IRA and turned it into $13,000. So trust me, you know a lot more than these guys. And this will provide you with quantifiable data, so you know that what's the chance of this price getting to here. And if you start thinking in the terms of probabilities and odds and let that permeate into your trading, be it the futures trading or options trading, it'll have a huge impact on your trading. And I tell coaching clients, I said, I wish I knew this stuff 10 years ago and a couple $100,000 ago with futures trading, and I'm going to talk about that a little bit and my thoughts behind that. But it's certainly an eye opener, and it certainly makes a sense why we all get stopped out and everything all the time. And I think for a great deal, if you hear me or if you've worked with me one-on-one, it totally relieves stress in trading. I have zero stress in trading. I've got positions that go against me, right now a couple bad ones for $1,000. I have no stress because I know that I know what I'm going to do. I'm going to sell premium. I'm going to roll it out. I'm going to do this. I'm going to do this. I'm going to try to work it back. Not every trade you can obviously get back to profitability, but I have no stress because I know what to expect. I know what the standard deviation, and I know what the context and the framework of this, so I'm not surprised if something happens, and I want to show you that on the chart relative to the futures. And here's another very important thing, and you've heard it in the courses: you really don't have to be right. If you look at that standard deviation bell curve that we've shown a couple of times, and you think about it, and you say, well, I'm going to sell premium in this area, I'm going to sell a future at the current price, and I've got a 34% chance that it's not going to go below this number, and I got a 34% chance it's not going to go above this number. You don't have to be right. You've got plenty of time for your future or option or whatever you've sold to move back and forth within that framework. And I want to show you the chart that you see me use every day in the room, and we'll talk about that a little bit in detail. So what really makes the math work? Because you can't just do one of these and say, well, that didn't work. It really is about, first of all, highly liquid underlying securities, and everything that I trade meets that kind of criteria. And we've talked about the criteria in the courses, and we're not going to do that. And obviously with trading an E-mini future or, maybe the Russell's a little thin, but obviously oil and bonds, and these are very, very highly liquid underlines. They got tight bid-ask spreads. You guys all know from experience you can get in and out. And the other thing is you do need a statistically significant sample size. Like I said, you can't be one and done. You go, well, this doesn't work. It's going to take a number of trades. I've done 5. I'm disappointed, but I've opened 500 trades this year. Now with the rolls and everything, I've done about, I think, 2,500, but I've only had about a little over 500 opening trades this year, and I'd like to do 20 a week, which would be 1,000. But you need a statistically significant sample size to prove to yourself that the math really does work. And so, in defined risk trades, obviously, if we're risking 2 to make 1, 67% of the time, we try to make, if we make $33, and if 33% of the time we lost it, this is if we went to expiration, the only person would be happy, we'd be zero, and the broker would be happy. So this is why you have to manage winners, and this is what makes the math really work. Now, you all know that kind of the hallmark is managing winners at 50%. Now, Tasty Trade has done a lot of research lately, which on iron condors and iron flies and straddles, I'm moving that up to 25% because that's more of the sweet spot. And we won't discuss that tonight, but typically I've said to manage winners at 50% of the premium you take in. That still stands for credit spreads, iron condors, etc. But let me show you why the math doesn't work. Is if you took a winner, every time you won, it was $33, and you won 67% of the time, and you lost $67 every time you lost. You can see that if you managed if you managed at 50% and you took that $33 and kept only and took it off at 50%, you got $17. But when you lose, you're going to lose 67. You're actually going to have a negative profitability, an expectation of $10.72 in that particular trade over a statistically significant sample size. But when you manage the winners, you increase the win rate. And what the research has proven, of course, first of all, not all trades are going to expire at max loss or max profit, expire worthless, etc. But if you take the standard 1/3 width iron condor with an actual win rate, say managed at 50%, the win rate gets up to about 88%. And I found that that's true I'm running about 87% this year. So that number that they've gone back to 2005, it ran thousands and thousands of iron condors, and that's about the number. You've got the opportunity to get out to 50%, and it raises that win rate materially. And we're not going to really delve into that tonight. That's not the point of this. I just want to kind of expose you to it because I think it's pretty significant. Because obviously, the first reaction is, well, if I win $67 or $33.67 out of 100 times, and I lose $67.33. I'm not making any money, and the broker makes money. So we'll get into this in a subsequent webinar and courses, but that's what makes the difference. That's why managing winners makes a huge difference, and I hope you see that in the results that I share in the room. And we'll have we'll be tallying the results for this year. Get ready to start another one. So I want to tie it all together. I want to show you a little bit of stuff on the option chain, and these are just the important things that we look at. Obviously, share volume, option volume, open interest. I'm not going to belabor this stuff. Delta, I want to really make sure that you have a good sense of delta, because as you start trading and you get larger and larger portfolios, you're going to be more cognizant of delta and what your real deltas are, either if you're short deltas or long deltas or whatever. Probability of in the money, how that relates to delta. Probability of out of the money, how that relates to delta. And one that people don't think about, and one I was never exposed to until the last 5 years, is probability of touch. And that's something I think will be a little bit eye-opening for you, at least relative to your futures trading. Well, this is just a real quick picture of, I did SPY, I think yesterday or today, and I set the option chain up. And you can just see, I couldn't take the bid ask off, but the important things for us are volume, open interest, delta, probability of in the money, probability of out of the money, and probability of touch. And you really don't need both probability of in the money and probability out of the money, because they're the reciprocal of one another. If you look real closely, if you add the probability of in the money and the probability of out of the money, they add to 100. And so you only need one of those, but I just kind of wanted to show them in this snapshot. I mean, I used to always look at the probability of out of the money, and I knew that obviously if one standard deviation is 16% of a probability of in the money, there's 16% probability it's going to expire out of that, like we showed on the bell curve, then that's 84%. But I've switched in the room recently, and in the last couple of months, and I'm really showing the probability in the money. To me, they're like I said, one's a reciprocal of the other. There's no magic to those. It's just you either look at it the 60% or the 83%. So you could say, do I want to look at the 83% probability that I'm going to be successful, or do I want to lose at 16? Evaluated at 16%. And then the thing I want to show you here, and I know it gets glossed over, is delta. Delta, if you look at the deltas and you start there, say at the 16%, you see the delta's 15 over here on the put side. The delta's 15, the probability in the money is 16. The delta pretty much goes hand in hand with the probability of success. And that's the only number that I used to use when I was introduced to options trading. But with the Thinkorswim platform, they have these which are a little more accurate. But for our purposes, you really use either one. If you want to not even show probability in the money or probability out of the money, and just look at delta, that's fine. You could say, okay, I'm on a one standard deviation. I want about the 16 delta. So You see me talk about the 16 delta all the time, or 16% probability out of the money. Now, one thing you really want to remember, and again, you don't need to show this on your platform, but remember that, and this is new to me over the last several years, and it was very eye-opening. You can calculate the probability of touch. Now, this is some type of formula, but again, just a back of the napkin calculation is like, look at that 16%. If you double the probability of in the money, the probability of touch is twice the probability of in the money. So what I'm saying there, and we'll look at it on the curve so it makes a little more sense to you and relative to futures. But if you say it's a 16% probability of expiring outside that, so, well, I'm okay, by the expiration date, I've only got a 16% chance that in this case it's going to expire below that, below, what are we, 209. So that's my odds. But remember, the probability of touch is almost 2 times the probability of in the money. That's why we get stopped out. We're sitting up here at this probability of in the money at 16%, and we think, okay, that's our odds, and then we freak out when we get touched. What you need to realize is you should expect to get touched. You should expect to get touched 32% of the time if you're stop, or if you're using stops, or if you're selling an option against it. You should expect that to be challenged twice the number of times that it expires within. So I hope that is clear. So if we're at one standard deviation, either top or bottom, and we can look on the top side, we're about 16.48% is 209. So if we sold this, today, if we sold the 209 put, we got a 16% chance of that not closing below 209, but we have a 32% of getting spooked. That's almost 32% chance of that getting touched. So, every time you put this trade on, 1 out of 3 times you're going to be challenged in this trade. The same thing on the top side. If we look at what's a 16% probability is 227. So we got say a 16% probability of it staying below 227. But we've got a 35% chance, look here, 34.93, 35% chance, again, twice the probability of in the money of being touched. And that's what gets us, because we think, oh gosh, this is a losing trade. I better get out. I better not, rather than losing $67, I'm only going to lose $34 or whatever the case is. That's why we get, I call it scared or puke out our trade. So I just wanted to point this out to you on the chain, on the option chain. Obviously, this is a Thinkorswim option chain. So now we're going to get into what we'll cover in a future class. And actually, I was talking to Bill today about a couple of Saturday sessions on this, but how this relates to futures trading. And I know all of you trade futures, and you hear me talk about it. And so I know some of you are very successful in using futures options to hedge your positions in lieu of stops. So what I want to go through with all that I've kind of gone over today, and I know I talk fast, but I want to try to cover it here and wrap this up so you can ask me questions if you have any. But I've turned the log normal distribution curve on its side. It's the same one that I've used, which kind of just is market profile. I mean, that just looks like market profile. You've got what they call them, single prints out here. I don't understand all that stuff. I don't know all the acronyms, the VPOCs and all that stuff. But it's just probability. So what I want to show you is, let's just say hypothetically, the current price when I snapped this picture was late in the day. It was 22.1150. So we're all taught, as we go, okay, we're going to put our stop here, and we're going to, if it comes above this, it's going to take us out. We're going to get stopped out for 2 or 3 or 4, whatever your stop parameters are. And this is what I've tried to convey in the room, and I know most everybody uses stop, but I want to give you something to think about. I don't think any of us, maybe once a year, once in a lifetime, can either sell the high tick or buy the low tick. So I'm going to assume that if the current price is $211.50, we might have sold. We don't know where we might have sold that, $210, $212, whatever. these price levels that I calculate are based on the Globex Open, so that they're static during the course of the day. I take the Globex Open to calculate the price levels. So given this Globex Open of 2205, we had a one standard deviation move was 2218 to the top and 2192 to the bottom. That was a range. We actually, I think, exceeded that range today in the regular trading hours, perhaps, or maybe it was yesterday. But nonetheless, I calculate those numbers. So what I want you to think about is what I just talked about, the probability of touch. So let's just say you 2205, you sold it at the open at 2205, and it's trading here, and you're starting to say, oh gosh, I'm down 6 points and all that. What I want you to think about is you really have about a 16% chance of it going up to 2218, but you've got about a 32% chance of it going up there and then finishing below. In other words, going up there, scaring you out of the trade, if you even take that much risk, and then closing below. How many times have we all put trades on? We got the direction right, it spikes us out, they run stops or whatever, it goes against you. So that's what really happens, that if you start putting some context and structure around this and say, oh, hey, it should go to 2218. 30% of the time. And look at half a standard deviation, which isn't very much. In this case, based on today's range, it's about 7 points. So obviously, if you sold the open, 2205, and you sold it right at the open, you got 7 points range to the top and 7 to the bottom. So that's 2212. And I know most people don't use 7-point stops. But look at the probabilities. If you got in there, it's got a 30% probability that it's going to stay below that, but the probability of it challenging that or breaching that is twice that. So it's 62%. So 62% of the time, you should expect it to go to 2212 or down to 2198, and that's what I want to kind of hope that I can get across. That obviously I focus most of the time on options, but this will lead in to why I'm an advocate of selling futures options to hedge my position. Because if I sell a future option and I sell it whatever, and I pick up 4 points, I've raised. If I sell the future and I sell the put, I've raised my the structure that I use. I typically raise my entry price by 4 or 5 points. So it's just something to think about. I took a picture of this chart. This is the E-mini. It had a volatility of 11.44%. For 1 day, the expected move is $13. So that's 26. That's plus or minus $13, which you can see down here. I need some annotation tools, but 13 on this side, 13 on this side. That's the one standard deviation move. So if you said right now I'm going to jump in the market, I'm going to buy or sell it, you sell 2111, you got a 16% chance that it's going to close the day below that, and you got a 16% chance it's going to close above 2192, and all these other numbers too. I won't go into each number because I think you probably get the drift. But I want to kind of wrap this up. And I did a little thing out here at the side where I showed you if you did a one contract, how much money you would realistically have at risk at each level, and we could talk about that because I'm kind of a proponent of knowing what the notional value is of what you're trading, and why I think it's unrealistic to control a $100,000 or $107,000 piece of property, or in this case, an E-mini contract for $100 or $200. And we've had that discussion before. So to wrap up, this is another. You've seen me use this in the room. I'm going to have this available in my member site. I'm doing some more tweaks on it, but you can key in any symbol here, and it puts all the pertinent data, which I think is a pertinent data. Then it lays it out for you. You can see graphically that, okay, here's the current price, 221.63, and this is dynamic. It moves up and down. And then obviously when we make the trade, we want to know what the range is going to be. And we can look here and say, well, we can expect this over I just have to plug in 8 days here. These kind of salmon colored fields are the only ones you put anything in, like the SPY, the 8 days, and then what your target price is. I forgot to change that. I was looking, so disregard that right now, because if I would have put a target price in, it'll tell you the probabilities of closing above or below. But you can look right here and see that, okay, well, if I buy or sell the SPY today at 221.63, or I buy or sell an option, here's my expectations. I got a 68.2% chance it's going to stay in this range, and a 95% chance in that range. So here's something I want to share very quickly. Let me take a real quick sip. Probably looks like Greek hieroglyphics, but all this is on the left where it says range is a half a standard deviation. Then you got one sigma. That's a term for it. 1.5, 2, 2.5, 3 is about all we talk about. But here should probably put it into some kind of context for you. If it's at the half standard deviation level, you're going to expect it. Your expected frequency outside that range is 2 and 3 times. 2 and 3. So 1/3 of the time it's going to stay within that range, 2/3 of the time it's without that range, and so on. So I hope that puts some context around what these mean, and you can just see as we go down how exponentially, we only talk about maybe up to 2 standard deviations. So 1 in 22, or once every 3 weeks. And you can look at some of these crazy ones when you get the 5, 6, 7 standard deviation. We'll have, every once in a while you'll have that 5 or 10 standard deviation move. But I just wanted to put this chart in to show you. Again, we're looking back here. Here's the 68.2 that you see all the time, and that tells us that basically 1 in 3 times. We've already talked about that. We're risking 2 to make 1. And that's why we do that. So this is kind of an interesting table of numeric values. Just pulled it out of Wikipedia, I think. So some future topics I want to cover in these webinars is I want to find, execute, and manage trades. I know there's a lot of interest in using future options to hedge. And like I said, I talked to Bill about having some Saturday classes on options trading and on this subject alone, and a couple other things that what I really want to do with when I get my membership site launched, and after this session tonight, I'm going to be on the phone for hours with the guy trying to get this thing wrapped up, is to see what you would like me to cover. I don't want to just force stuff down your throat. I would like to. I'll come up with a list of topics, and we'll see what the consensus is. And here's something that this is the last thing, and I don't think this copied the PDF, but I don't know why this little clip sticks in my mind relative to options trading or even to futures trading. But I always say, quit trying to figure it out. We're all engineers at heart, and we want to be right. I said, you don't have to be right to make money doing this. Mark Douglas said that years ago, and I didn't know what he was talking about. And it didn't make any sense to me. Now I know. But this little clip, if I can get it to run, I embedded this code. This kind of is an analogy for me of trying to figure it out, and then, oh hell, I'll just shoot the guy. So this guy comes all these ninja warrior, and he's got all this stuff going on, and Indiana Jones just pulls out his gun and says, oh, hell with it. I'll just shoot the guy. And I just kind of draw this analogy. It's kind of comical, but strangely, in my mind, I draw that analogy to trying to figure all this stuff out. Quit trying to figure it out. Put the math in your favor and let it go. He had a golf club. Okay. Well, that wraps it up for me, and I really appreciate it. I ran a few minutes more than I wanted to. I tried to keep it under 50, and I'm 59, I guess. But